This is the London Fintech Podcast, bringing you practical insights and approaches, stories and inspiration from the innovators who are building the new world of financial services. This podcast is brought to you by NextWave, strategy specialists and solutions for financial institutions. I'm Tony Clark, and this is the London Fintech Podcast. This show is all about stories of innovation and success from the world of fintech. We've guests on this show from firms of all sizes across the sector, talking about their journeys, and one thing has been clear, that the market and investment landscape has been far from static. What with interest rates, elections, and fintech investment and M&A activity that's been on a roller coaster over the last 2 years, now is probably a good time to take stock and ask where are we now and what's the outlook from here. Today's guest comes armed with a timely and deep set of insights into the state of European fintech, which should be equally interesting for founders and investors alike. Aman Ghei started his career at Credit Suisse in the Global Technology Group, working on IPOs and capital markets transactions. He's been an investor with Accel Partners at Facebook, leading partnerships, and a product manager at a leading mobile games developer prior to joining Finch Capital around 8 years ago. Welcome, Aman.
Thanks a lot for having me, Tony. Really excited to talk to you about European fintech today.
It's great for you to be here on the show, so looking forward to getting into this. Tell us a bit about you, just to get us started. You've had a pretty interesting journey because you've been a deal maker, an investor, and you've been on the tech development side. So can you tell us a bit about your career and what led you to Finch Capital?
Yeah, absolutely. And it's been an interesting ride. As you said, I started off in tech M&A, mostly actually doing payments. You know, in Europe, tech is really payments, especially large cap. So at Credit Suisse, it was mostly that. And then got a chance to join Accel Partners, which is probably one of the best venture capital firms out there today, and was really my framework in helping me develop how to invest, what to look for, and really took that and wanted to get into the operating side after that. So this was back in 2011. Facebook, which is actually a portfolio company of Accel, had just gone public. And, you know, we're trying to figure out how to make money on mobile. And a large part of that was around games distribution. And so got a chance to join them and really run that part of the business for them here in Europe. I spent a number of years there and kind of taking my gaming hat on, decided to join a small studio here in London, or start a small studio here in London for a big game developer called Nordics, which is now Take-Two, and did that for a couple of years as well. The venture or the investing bug bit again, and I met the guys from Finch a long time back. It was pretty much the early days of Finch. You know, we now manage $500 million. At that time, it was 40. And so we've come a long way, and it's been a really interesting journey for me.
Fantastic. As you say, very varied career. And I love that Facebook experience. I mean, I know in the Facebook journey, that pivot to mobile was such an important thing to stay on the front foot ahead of a market that was moving away from desktop to mobile. There's a fascinating, I think it's a 6-hour episode on acquired.com about the meta journey, where they dig into this far better than we will on this show. But really interesting set of experiences, and I guess sets you up very nicely for what you're doing with Finch Capital, because you're looking at investment cases and you're looking at the growth opportunity for the portfolio companies that you bring in. Can you tell us a little bit about Finch Capital?
Yeah, absolutely. So, you know, we've been doing this for about a decade here at Finch now. We manage about $500 million and invest primarily in European companies. We're investing generally anywhere from 5 to 15 million euros first checks into businesses that are probably post-revenue, into what we call kind of 7 different verticals. So banking, payments, insurance, wealth capital markets, and then some of the boring kind of critical business technology stuff. So think tax, accounting, HR, payroll, legal and regulatory and compliance solutions. So the way we kind of think about the world is financial technology and business technology. That's really been our bread and butter for the last decade or so. Have invested in over 50 companies, likes of Zopa here in the UK, Good Lord, which is one of the largest insurance distributors in the home insurance space, Tax Scouts, Accounts IQ, and many others.
Which I'm sure gives you a really good perspective across the sector. And as I said in the intro, I feel that the investing landscape has been on a bit of a roller coaster, and we've come out of a very interesting few years. And I guess one would argue maybe we haven't come out of it, but the market's just
Yeah,
evolving into a new pattern. So the research report that Finch has produced is timely. I think the audience here, that I would expect there's a segment of the audience here who are highly tuned into what is the state of fintech, what's going on in the market. And I believe this is the ninth time that
ninth
you've
one.
run the report. Can you tell us how do you go about doing a research piece like this across such a broad landscape?
Yeah, I think it starts from us obviously spending a lot of time in the market. We meet about 2,000 to 3,000 companies a year in this space and look to develop a little bit our thinking around what a interesting company should look like. And we do deep dives into certain sectors. So that's the basis, building blocks. But then we overlay a lot of that with some of the industry data sources. So we use PitchBook, Dealroom, to really kind of get a true sense of what the pulse is in the market, where's funding going, what are the sectors that are seeing kind of most funding, not only looking at it from a volume perspective, but also from a what we call value perspective. So are there mega deals? Are there kind of just smaller deals? And then we overlay that with our analysis and try and understand a little bit more the metadata, so to speak. Where's valuation going? What are investors really? What do they really care about? Do they care about profitability? Do they care about growth? Do they care about both? And how? And so that's about how we go about doing this. And as you said, kind of ninth year, it takes about kind of 3-4 months for us to really put together and develop our thesis around the market as well.
That number of firms, 3,000 firms, are you on the road a lot?
Funnily enough, I think, our business has changed since COVID as well, right? I think we were on the road a lot in 21, and that has changed. It's become okay to do a first intro call on Zoom now. And so we spend, I would say, a decent amount of time trying to meet people locally as second meetings, but the first meetings are generally around a video conference. And then we try and spend a decent amount of time in cities and do back-to-backs with a number of companies over a week that we've identified as third meetings. So a fairly kind of structured sourcing approach, so to speak.
So the European Fintech report for this year, what's the country coverage that you've got here?
Yep. Yeah, so we look at all European countries, and then we zoom down into the kind of 7-8 most relevant ones. So obviously the UK is the most relevant one here in fintech. But we also spend time in Germany, Ireland, Poland, France, Spain, and the Nordics as more kind of focus groups. But from a data perspective, it's basically looking at the entire European market, including the UK.
Yeah, and I guess we'll get into it a little bit when we explore the findings from the report. I understand the UK is the larger part of that, but it'd be great to get some perspectives from across the Eurozone. Just taking it the other side of the Atlantic for a minute, where do you think we are in the economic and market cycle? Because we've just had the US election, interest rates are on the way down everywhere, but we've come out of this period of very little M&A activity and uncertainty about the outlook. How would you characterize the cycle that we're in now, Aman?
Yeah, I think we're still in a tricky spot, to be honest. I think the US is an interesting market. It always has implications around what's going on in the rest of Europe. I actually met an interesting banker the other day, and he actually said, they only do $1 billion deals, and most of the $1 billion deals they've done in the US have actually been put on hold because of the FTC and the regulations on the Democrats. So I actually think, well, it's hearsay at the moment, but I think there is a belief, at least in the investment community, that for whatever you think of Trump, there will be a unlocking, so to speak, of M&A. And that has a big impact on the investment landscape globally. At the end of the day, capital is stuck. People have invested lots of money into companies that are still private, and either they need liquidity from public markets, which is quite hard at this point with interest rates where they are, or they need liquidity from M&A, which has been so-called stuck in the US in particular. So we're still in a tricky spot. But yeah, I do think kind of, at least from a regulation standpoint, supposedly under Trump, that would have a more positive effect.
Yeah, perhaps some anticipation building up. I know in the report you've highlighted US investors pulling back from big deals and from, I think, making the majority of investments in the Eurozone to no longer being the majority investor. What are your thoughts on the new presidency playing across into the Eurozone?
Yeah, so it was interesting. I think kind of in 21, 22, what you saw was a large number of U.S. firms set up offices here in the U.K., right? So Enrica and a number of others. And I think kind of realized that they could source investments here just like they do in the U.S., because everything is kind of fairly on Zoom these days. So, that's changed actually in 23, 24. Obviously, they've been impacted a bit on liquidity. Their LPs are telling them that they need to focus on distributions, and as a result, have probably stepped back from markets that are just far away from them. What's happened as a result is local investors have stepped up. So most of the capital that is being raised now in 23, 24 is coming from European investment firms as opposed to the US firms. They are starting to make a slight comeback, particularly in certain sectors. So some of the big deals, for instance, whether that's in the banking space or in the crypto space, are being led by U.S. investors. But I think kind of from a Trump perspective, it's just unclear right now what's going to happen. I think that's part of the allure with Trump, is there is a lot of chaos, and sometimes you don't really know what's going to happen. But I think the investment landscape is just directly correlated with interest rates, as much as we like to say that or not. And the higher the interest rates are, the more asset managers are going to look for, alternative classes. The less asset managers are going to look for alternative asset classes, because they'll just stick their money in something that pays high interest rates. So we do need to see interest rates come down. And I think if Trump does signal that, we'll start to see kind of an impact in the Eurozone, and a lot of kind of US capital coming back into Europe.
Yeah. And looking across the Eurozone, which countries are the interesting ones for you? I think the survey highlighted that majority for the UK. I think 65% of investment in the first half of the year, $12 billion. But there are other places as well where there's increasing activity levels.
Yeah, the Netherlands is quite interesting in particular. They have a very kind of sophisticated payment ecosystem. Obviously, we talk about the alumni from Klarna or TransferWise. The Netherlands has the alumni from Adyen and a number of other payments businesses. And so we're seeing kind of very interesting companies come out of that region. A lot of it has to do with kind of local governments putting into place strategic programs. Germany is the one to look out for, I think. If you think about where Germany is relative to their peers, the UK, France, they've been left far behind. And they've really missed the broader kind of AI wave, as well as some of the fintech wave that we saw in the early 2020s. So the government there has really shown a strong footing, and really kind of trying to aim to attract more private capital, putting together programs in place. So Germany's some place to keep an eye on. And then, beyond that, the Nordics have always been fairly interesting: Sweden, Norway, Denmark. And we're spending more and more time in Poland, actually. Poland has a very interested kind of talent base. Not many people know, but most of Resolute employees are actually in Poland, and tech talent. And so if you're trying to build a team that requires kind of fairly kind of technical expertise, Poland's a good place to start. Obviously, the commercial arm has to be a little bit separate. So they're very good pockets beyond just the UK, but you just have to spend some time there.
Yeah, it's an interesting point about Poland. I've seen that in the technology and the analytics teams of some of the big incumbent banks for some time. Less aware of the sort of Polish fintech scene, if you like. That's an interesting one.
Yeah, the problem is people look at Poland and think, is your local market big enough? But that's not how you should look at it. You should think about it as, do I have the talent to create a global company there? It was actually a really interesting business, not exactly kind of fintech, but I'll give you the example. 11 Labs, Voice AI, the entire engineering team in Poland just raised a massive round from Andreessen Horowitz. So you're starting to see kind of technically focused talent really shine there, but you do have to build commercially for a global audience as opposed to just a local audience.
That's a great example. I've mentioned 11 Labs on this show before, and I had no idea the engineering team were in Poland. Those AI synthetic voices are remarkable, and it's as an aside, but there's actually a synthetic version of this podcast which I've run through one of the AI generators. I don't know whether it's using 11 Lab voices, but anyway, not to go too far down that rabbit hole. But what we can do with voice and generative AI is now extraordinary, and maybe I'll be out of a job soon, but let's see.
Maybe this podcast will be purely voice AI in the future.
Yeah. Well, anyone who hasn't seen that, look on my LinkedIn. I posted an AI regenerated version of one of the earlier episodes, the one that I did with Louis Glass at CMS, and Notebook LM turned it into a 7-minute podcast, complete with 2 AI presenters, which was it's quite a head spin actually. Okay, so going back to European fintech, so where is the investment going sector-wise? Because if you look across FS, fintech broadly, it's a really wide sector. So we've got banking, insurance, markets, the buy side, we've got crypto initiatives. So where are you seeing the interest?
Yeah, so I think there are 2 ways to segment this actually. So I think if you just look at the sheer dollars, that's just going in one area, and that's actually just banking. And they're going in big deals. So Monzo, Revolut, they make up a big share of that. And there's a reason for that. And the reason is they've fundamentally figured out their business models. Okay, interest rates help, but they've also diversified from just interest-only revenue generating products. The flip side to that is volume. So where are the most deals happening, irrespective of dollar value? And that's in the crypto space. And they're smaller deals. And we've seen this, what we call the end of crypto winter. And that's partly because people are speculating around a few things, right? So one is, what is the stablecoin infrastructure going to look like in the future? And is there room for that in Europe? I think Europe has been a bit ahead in terms of regulatory advice from the government around this, and is moving more and more into an environment where crypto will be regulated. And actually, that gives investors like us a bit more comfort into investing in these types of assets. So those are the 2 main sectors at play. You know, the banking sector is really kind of on a roll in terms of dollars, and the crypto sector in terms of deals.
And the report also calls out lower deal sizes, low to mid market, sub $500 million deals as a theme. Can you talk to?
This is, I would say, one of kind of Europe's hidden superpowers that not many people talk about. I think we're so focused on these large exits, and we often kind of get caught up in Europe trying to replicate that, particularly for the US. But what actually Europe has is a very healthy mid-market. And if you look at the number of deals that happen in the kind of 50 to 500 million range, they're exactly the same or close enough to the US market. And the reason that happens is Europe has a very well-developed private equity M&A ecosystem. So private equity buys a lot of our businesses. And so it's a mindset change that I think we need to figure out in the investment community is, how do we position our businesses not only to be, hyper growth, very valuable businesses, but also businesses that can be very valuable in that private equity mindset of a 50 to 500 million outcome. So we're quite excited about that. I think we position ourselves to be able to do that because, in reality, the 7 largest US companies, have a market cap of, I think it was 7 trillion. 7 largest European companies have a market cap of less than $1 trillion. So, you're comparing 7 trillion to $500 billion. The buying power in the US is just so much larger. But that doesn't mean there isn't any buying power in Europe. And we really think it's in this mid-market where a lot of people need to spend time focusing on.
Yeah, that's really interesting. So I was going to ask you, where's the investment coming from? And I think I'm hearing that there's this PE layer in Europe. We talked about US investors perhaps standing back somewhat. Let's see how that evolves. But that mid-market appears to be very strong across Europe and driving much of the growth. I mean, talk to me about multiples across the sector again, because different types of firm here, different stages of evolution, and I feel that we've coming through an era where perhaps it was build it and client acquisition and less focus on profit. And again, the report calls this out. It's very much about sustainable growth and EBITDA in the current phase. So, how are multiples looking across the sector?
Or what our investors like us like to call rule of 40 these days. But look, the reality is really...
Tell me, what is the rule of 40?
Yeah, it's the magic bullet. No, I'll start with rule of 40 first, but you can call it a metric, which is very simply revenue growth percentage plus your net income percentage. And is that number greater or equal to 40%? Okay. It's a very rudimentary metric, let's put it that way. I think there are much better metrics out there. But what it does do is, in times like where we are right now, where capital is constrained, it does focus the investor and the company into thinking about how do you grow this business in a capital efficient way. That's the purpose of it. It's not a magic metric to solve all your problems, so to speak. A lot of people have been speaking about it in terms of, you do need to meet this benchmark for us to be able to have a conversation. Otherwise, it's just going to be a very difficult conversation. But going a little bit more into multiples, I think this is interesting because, if you look at where multiples were in 2017, let's take a B2B business in the fintech space, right? What they were in 2017 to 19, they're actually very similar to what we are right now. So kind of in the kind of 6 to 7 times revenue ballpark, 15 to 20 times EBITDA ballpark. And so it was only kind of in that 20 to 22 period where we just saw some crazy multiples being paid, truth be told. So from a valuation perspective, I know a lot of people kind of try to say we're in a depressed market, but actually we're in a fairly stable market. Then you kind of overlay is, particularly in kind of some of the B2C stuff in fintech, is how should you value a business? How should you actually value Monzo? If you look at like a HSBC, they're valued at price to book or return on assets. Do you value Monzo on return to assets, or do you look at it on a revenue multiple basis or an EBITDA multiple basis? Gets a little bit more complicated when you look at lending businesses, for instance, lending technology businesses or insurance tech businesses, people who are distributing your premiums without actually having capacity or a book. How do you value those businesses? So it gets a bit complicated in fintech. It's not like software where generally a business has, fairly recurring revenue and, it is a kind of 6 to 8 times revenue multiple, maybe a 15 to 20 times EBITDA multiple.
Yeah, does the sector have generally accepted models? Because to your point, exactly that example, if you were measuring a multiple of transaction fees or revenue and not worrying about the bottom line, but now we're worrying about the bottom line. So how do you layer in multiples of EBITDA to something that has been traditionally perhaps measured on in terms of footprint? So how's that all working?
I think this is the art part of valuation as opposed to the science part of valuation. And this is where, as a valuer of the business, you have to have a kind of outlook in terms of what does this business look like from a profitability perspective in 2-3 years, and get comfortable with, this is that level of multiple I'm willing to pay for right now, today, for that profitability to be achieved in 3-4 years. So it is that kind of bridge that I think You do need to draw to get comfortable. It's actually one of the reasons why in the market we are in right now, it's very hard to get deals done because there is a lot of art and not all artists have the same view of things. And as a result, getting a deal across the line is just taking longer. Before I think everybody was fairly focused on one multiple, which was revenue multiples to get a deal done. And as a result, deals just got done quicker. So it really depends on what people are comfortable paying, and it depends on the industry. And I think that's why you're seeing a little bit more of a move in fintech to more software-like businesses, more payments-like businesses, because there is a little bit of more consistency around what are these businesses worth and how do you value them.
Yeah, so you're buying, I guess investors were always buying a future vision and projection, but were more comfortable with a loss-making situation to get there because you're buying footprint essentially. It was always going to be a big bet on building a product or a service that was going to get traction in the market. But what I'm hearing is that there's now more focus on path to profit. Are there certain things that as an investor you look inside that firm and say, well, that's what I'm looking for, this and this, to give me that comfort that this projection is one that's got a high likelihood of succeeding?
Yeah, so I think there's not one certain thing. I think as an investor, you try and build a model out to understand what are the levers that you can pull to really get there. Let me give you an example. Let's say a client has, a company has 50 clients, 50 banks as clients, and you recognize that, within these 50 clients, they are in one trading desk per client. And so you need to build a model to understand what happens when they are in 4 trading desks per client. And as a result, my go-to-market is account-based as opposed to new logo-based. And what that means is I need to hire maybe less new salespeople, but more account managers. And this is what my growth really looks like. So it's building that picture in your head that has many different elements to it is important to give you a good feel. Because look, Excel will give you any answer you want it to give you, right? So, but you do need to kind of paint that picture out in terms of what do I really need to pull from a lever perspective to achieve this, and that is different. I actually think payments companies are quite interesting these days because call payments the gift that keeps on giving for investors because no other vertical in fintech has ever returned so much money to investors as payments has. So I think a lot of people look at payments and think this is a really interesting space to invest in. But take payments multiples. Adyen trades at, I think it's 15, 16 times net revenue today. Someone like a dLocal, which is in South America, trades at 10 times. But if you look at some of the more developed peers, they trade at 5 times. And the difference there is, investors are valuing growth. Adyen is growing a lot. dLocal is growing a lot. And so they're looking at these businesses and saying, actually in the payment space, we believe that profitability can be achieved. We've seen that. We don't know is if growth can be achieved. And if you are achieving growth, that's the premium you're going to get. So that's how people do view these things.
Great examples. Let's go to payments for a minute then, because I was going to ask you about some examples in the different fintech sectors, and you said payments is really interesting. There's some interesting diversity of valuation there, and payments super crowded. There are thousands of payment firms out there. So when we say payments, are we including buy now, pay later? Are we talking about embedded finance plays? So if you can just unpack that a little bit for us in terms of payments firms and why you think the payments is exciting.
I think we take a fairly broad view initially to start off with payments. So we would include kind of buy now, pay later. We look at anyone that is processing payments. So if a buy now, pay later player is processing the payment, we kind of think of them as a payments player. So you're right. It is a very industry, very complicated. Are you doing acquiring? Are you just doing the gateway? Are you doing Anything on the back end is fraud included in payments. And so you do need to kind of unpack those, because each of those actually have different valuation adjustments, so to speak. Acquiring is a slightly more riskier part of the business in payments than it is to be a traditional gateway, but also as a result acquires a slightly higher multiple to adjust for that than a gateway side of the business, which is maybe a little bit cleaner, but doesn't involve kind of the interesting value chain piece that you could own. And the reason why payments has always been interesting in Europe is a very complicated payments market, because each country has its own schemes and own regimes. And really there's been a local focused approach to building payments businesses here. So in order to build a pan-European payments player, what do? You go out and acquire businesses. That's the only way to do it. And then that's why Europe, I used the phrase, the gift that keeps on giving from an investor standpoint. That's why Europe has been great. Look at MasterCard. They've acquired so many businesses. Nets was their last one in Europe. Visa as well. So the payments has been really, really interesting. But there comes a point in time, and we're trying to seeing this now, is, you've solved all the problems that you could solve, right? Like, what's the point of starting another payments business in the UK, for instance, right? There's so many payments businesses in the UK. And the short answer is not much really right now. The interesting elements of payments comes in, can you acquire licenses in hard to get geographies, for instance, in Southeast Asia, where there are very few licenses available, and you could really change the value chain there. Going back to dLocal, what they're doing in South America, really, really interesting as well. So a lot of these payments companies are looking at these different angles now to see where the growth can come from.
I can see that. And from the M&A perspective, that consolidation play to create a regional capability, I think, presents opportunities. Yeah. Have you got some other examples of interesting deals? I think there's something in the report about failed airline payments. There's a firm out there that's come up with a solution for dealing with airline penalties across the region or something. I mean, I may be describing that very poorly, but I quite like niche use cases that are taking friction out of the system, that just solve something that seemingly might seem like it's a simple problem, but for which there is no current solution. That one jumped out. But what are your examples, Aman?
In payments, again, I would go back in the B2B payments side of things. Take the US market, for instance. They're very focused on how do you disrupt the check ecosystem, right? So ACH, still accounts for, I think, about 60% of all the B2B traffic. It's actually not too dissimilar here in Europe, right? And so we're seeing a lot of businesses that are very focused on the B2B side, almost, of buy now, pay later. So people that want to have flexibility around buy now, pay later, but again, more on the B2B side. And the question then becomes is, how do you offer this on low cost payment rails, right? So SEPA or a BACS, how do you kind of almost supercharge these payment rails to be able to offer the flexibility that maybe a credit card does of allowing, customers to pay later? I think that's a really interesting problem that people are solving. At the end of the day, payments companies live and die by conversion, right? Mm-hmm. So if you're not able to prove that you can convert better than your competitor, they'll just swap you out. Companies are very good at doing that. And then finally, maybe one thing that maybe surprised all of us a little bit is the reemergence of buy now, pay later. So we've started to see that really emerge as a relevant kind of competitor almost to a card. I think kind of a firm came up with these numbers. 30% of their GMV is now across categories that, never really existed before. So like restaurants and grocery stores, and that kind of behavior is very much like how you would behave with a payment card. So we are starting to see something in buy now, pay later for the consumer side as well emerge in payments.
Yeah, and I think I'm right in saying the report observations on buy now, pay later were about increasing regulatory comfort, the use of advanced analytics and AI now to do more accurate credit scoring, and that there's a sort of maturity in the sector that's driving that re-emergence. Is that fair?
Yeah, that's fair. And I think part of it is also driven by the focus that these companies went through in the last 2 years. We sold a company to Zip, a company called Quisto. Zip is a listed Australian buy now, pay later business. And, in 21, 22, a lot of these buy now, pay later businesses were very focused on market share. They just wanted to be in every country and really get share of wallet in those countries. And what you don't realize is when you do launch a new country, you go through a period of 1 or 2 years where your loss exposure is quite high. Your algorithms need to learn and understand what is that consumer like. And because of kind of the macro environment we went through in 21, 22, they started pulling back and actually focusing on markets that they know well. And as a result, surprise, surprise, they actually started doing well. And if you look at a firm and if you look at a Zip and, Klarna obviously filed secretly to go public next year. Yesterday, you're starting to see that.
Just on that one, Aman. So
Yeah,
I almost missed that soundbite. So filing yesterday, which firm was that?
Klarna filed. So I forget what the exact term is called, but essentially secretly to go public. So they haven't revealed much in terms of numbers, but they have made a notification to the SEC that they would like to go public.
And I think when you do that, you can actually go to market in as little as 3 weeks afterwards. So, watch this space. So anyone in the audience listening to this recording could probably date the exact recording date from that comment. Yeah. But I didn't know that, and that's pretty interesting. They're one of the bigger players.
Yeah, definitely. And I think, you could sense that coming. I think they were making a lot of noise in the last 6-8 months around the cost efficiencies, around what they've achieved, particularly around AI. I don't know how much of that is a function of kind of marketing and equity story versus actual kind of bottom line. But at the end of the day, I think they wouldn't be in a position where they are right now if they hadn't taken kind of drastic measures to focus themselves in the last 2 years on markets that really matter to them. So I think a lot of, and this is what I mean by kind of fintech is in a very different place to what it was 2 years from now, because people learned their lessons very quickly in this market and focused on profitability and the flight to profitability as quickly as possible. And you're starting to see some of the benefits of that, particularly in the larger companies.
Yeah, I think the Klarna headline, the way I remember it was that they took 600 agency staff out by using AI. But then if you sort of unpacked it, it was third-party agency staff rather than their own team. But nonetheless, they'd driven that efficiency. And I think are thought of as being sort of on the front foot in terms of AI-enabled operations, which is actually quite a nice link to a couple of other things that came out in your report, I think. So insurance going all in on AI, there's an interesting stat that apparently 4 out of 5 actuaries are now using AI models. And I think your other sector focus, certainly the one that I noticed, was that there's more credible offerings in the crypto space around stable coins as well. So I know I'm sort of cherry picking things from your report, but you tell me, is there anything else that really you would highlight sector wise from the findings this year?
So let me pick on insurance, because I think insurance is an interesting one. They've been behind the banks, truth be told, in the last kind of couple of years to really get on this kind of technology curve. And what we found is pricing software is where it really hits them hard. So 2 very interesting companies. One is called HX, Exponential, you might have heard of it. And the other one, Accurate in France, that raised massive rounds around pricing. And the issue that the insurance companies had was, in order to innovate on product, and what I mean by that is in the ever-changing landscape of I need to adjust rates, I need to adjust how my product is marketed, I need to add elements to my product, it was taking them on average 3 months, 6 months to be able to do that. And what these new companies have done has been quite instrumental is they've come in and said, here's our platform, put your entire backbook onto it, and within 2 minutes or whatever that hypothetical number is, you can make changes and go live with new products. And that is fundamentally changing the way these insurance companies are thinking about technology, thinking about AI. Because pricing has really been the area where they make money, but also they lose money. And so if you can kind of build products for them in that sector, and look, I think that the question a bit there is it a winner take all kind of market? Are you going to have 3 or 4 kind of players that really kind of go to all the insurance companies? Because it is a little bit of a virtuous circle of, if you work with 10 insurance companies, then the other 10 want to work with you as well versus another player. So I think there are elements of that there, but similar to what we had in banking, where I think there are now kind of handful, maybe 4 or 5 kind of banking as a service platform providers that have emerged to be winners. You're going to have that same thing in the insurance.
Really interesting, and sort of falls into the category of, and I've talked about it before on the show, useful AI, where AI and new models driven by technology are really moving the needle in terms of operational efficiency, or frankly, being able to offer a new type of service or product. Let's switch it up a little bit and talk about playbooks for success, and starting with, and you mentioned products for particular segments of the market, but product market fit and a successful trajectory for a fintech. Maybe if the trajectory 3 years ago was have a great idea, hire a big team of engineers and build world-class product, let's worry about the bottom line later. I sense the playbook now is a bit different. So how would you characterize a successful playbook? You're starting around perhaps a mobilization, business plan, angel round, that sort of thing. But then you've got an eye to becoming a scale player. And I know that's probably a long conversation, but if you could hit on a few milestones, perhaps, or a few things around the approach that you'd be looking for a successful venture.
Yeah. I think let's focus a little bit on a B2B business here, because I think that's where the playbook piece really comes out very strongly. I do think you need to make a decision early on, which is, do I focus on tier 1 or do I focus on tier 2 in the short to medium term to build my business? Because that really dictates how your playbook is structured. If you do focus on tier 1, what you're really looking for is 5 to 8 customers and your ability to go deep into them. And this is my example around, if you remember the trading desk example, which is, can I kind of get 5 banks as clients and literally sell them in every location that they are? Go very, very deep across every product function, across every geo, and go deep. But that, you have to set up your company to be able to do that. The other way is more tier 2s, tier 3s, which is, I want to focus on net new logos. So I'm really going about acquiring logos. And I'll figure the rest out a little bit later. And that you set up as, from a go-to-market perspective, is how do I acquire these net new logos, and how do I have the right sales team structure to be able to deliver that? And what does it look like? What does success look like? I think that really depends. For us, I would say if you have 50 customers in tier 2, tier 3, you're on your way to kind of achieving product market fit. In tier 1, if you have 5, 8 customers, you're on your way to achieving product market fit. But 2 very different ways of achieving product market fit, so to speak.
Fundamental distinction there, yes, between going for a small number of tier 1 scale clients and going deep versus acquiring logos across the mid-market. Anything there in the ideal Aman playbook around how you set yourself up for success as a startup, as a scale up in the fintech space?
I wish I kind of could give a silver bullet answer. And I really find it kind of almost patronizing for entrepreneurs to hear from an investor sitting on the other side, kind of, this is how you should really do it, when they're the ones who are actually putting all the hard work into practice. Look, fundamentally, investors want to invest in businesses that actually don't need money, right?
Yes, it's a great point.
It's an important rule. And I don't mean that in the literal sense. I mean that kind of also more kind of philosophically, which is, are looking for more than money that kind of comes to the table. And you always want to be in that position as a founder. What am I really looking for from the next set of investors, if at all, to take my company forward? And actually, what can I do without them? I know I'm probably doing myself a little bit of a disservice, but you should always kind of focus on, how am I actually building the business for myself first? Because the investors will find you. I always tell founders this is, if your head's down and you're focusing on building the business out, an investor will find you. These days, it's really easy to find businesses. When I started out investing, we used to cold call founders on their contact us number. We didn't have LinkedIn in those days, so cold call founders on their contact us number and ask them to speak to us. But these days, they're very easy to find. My only advice would be keep doing what you're doing. Depend too much on investors getting involved in your journey because they will find you. You have to be able to adjust a little bit to what the market is, right? So I think in the market today, you either need to be kind of fairly bootstrap, capital efficient, or you need to be showing kind of hyper growth. And by hyper growth, I mean you need to be showing you can grow 300, 400, 500% to be able to get kind of venture money. So the more flexible you are in terms of adjusting to some of the market kind of dynamics, I think the better you are placed a little bit for the long run. But again, I go back to the basics. If you don't need money, the money will generally find you.
Yeah, I love that.
Is what it does. Yeah.
There's a couple of great points there. So the money will find you. I mean, it's true in our consulting business, in the Next Wave consulting business, we picked up a couple of awards last year, and with the amount of approaches we've had from the market, and that's a different story around timing and the trajectory for that business. But I'm continually surprised by the people who sort of find us through LinkedIn or through wider networks. And the other point you made there a little earlier about customer acquisition is so important. My observation on this one would be make sure you've got enough commercial DNA in your team, because. And actually, last episode, I was talking to Chinen Louis, who's been a founder and an investor in Asia. And we were talking about fractional assets, but we were also talking about the founder journey. And there's a little reel that's, I think it's up there on LinkedIn, actually, from that conversation about Chinen saying that he had a bit of a wake-up call where he had to realize that he had to pick up the phone and start calling clients, and you have to really just be so immersed in that prospecting activity. And the fintechs that I know really well, one in particular has done extraordinarily well, and they had really strong sales teams from the very beginning. And I think there's a temptation for the product and engineering teams to go and build great product, and you build it and they will come. And actually, especially selling B2B, it's really hard, and you need a team out there that are generating demand right from the beginning.
Yeah, and it's also really important for the CEO and the founder almost forever to keep on selling. If you look at someone who I admire quite a bit, is Vish, who's the CEO and founder of Quantexa. And we just sold
That's so funny because that's the context I was just talking about.
Yeah.
So,
really? Okay.
Vish and the team are that's our decision intelligence partner in the consulting business. So
Yeah.
and they've been all over LinkedIn. Again, you'll be able to date this episode with the 100 million ARR announcement. Fantastic job. But that firm, the sales teams were a huge focus right from the very beginning. Sorry.
Yeah.
I mean, I think we're
but I was saying, like,
the same point.
Even if you look at someone like Vish, he's still spending time with customers, and that's such an important thing for a CEO to keep doing throughout their journey. I think it's sometimes quite easy to step back and kind of say, I'll just focus on the strategic piece, or I'll just kind of manage my teams, which you still have to do. But the CEO is such an important link between the customers, and you can have product marketing and all that stuff, but the CEO is the real link between the customers and the product. And it's so important that they continue to do that.
There's another shout out for Quantexa on this show. Then that's the second one in a month. Vish has been on this show before, and maybe, who knows, maybe he'll be on it again. But but that's one to watch. So if you're in the fintech community and wondering sort of how to go about dividing your time and focusing on clients and the sales piece, then you'd do worse than to take a look at what Quantexa are doing, I think.
Yeah, absolutely.
Yeah, very good. And so let's just think about moving forward a little bit then, because we're going to run out of time shortly on this conversation. And there's such a lot in the Finch report. And so just I was going to ask you on your thoughts and your advice for the audience. But just before they do that, as a summary of the findings of the research this time around, if there were three things that you'd want the audience to take away as learnings from all the work that your team have done, what might those be?
I would say the first thing would be, don't get too caught up into the details around how much funding has dropped. I think there's a reason why funding has dropped. Part of that is also because people don't need that much money before because they focused on profitability, and that will come back. So I think funding will come back. The second piece is stop unicorn chasing. Focus on building your business. Don't worry too much about raising kind of large amounts of money because you want to build this $10 billion business for somebody else. So focus on really building your business, because it's actually a very interesting kind of mid-market M&A ecosystem out there. And I would say the third question is how long this will be relevant for is, if you're able to show kind of strong rule of 40 or kind of strong elements of capital efficiency, some people kind of call it burn multiple, which is effectively for every dollar you're burning, how much new ARR are you generating? Those are really important metrics to have as you grow into raising a larger round. So those are the three kind of most important things I would highlight.
Thank you, Aman. Really helpful. And any particular predictions for the next 12 months in this space?
Oh, I wish I had a crystal ball. I think predictions are always tricky. I think kind of the one thing I would say is I think we're going to see a lot more M&A than we would have usually. I think we're getting to a point where there's this bid-ask spread, which the people always want X amount, and buyers are willing to pay Y amount. That spread has been really high in the last 2 years, and I think we're starting to see that spread come down a bit, and so that will obviously unlock M&A a great deal. But look, I think we all need the IPO markets also to start working again. I think, of course, it brings liquidity, but it also brings confidence at boardroom level for these companies to do things like M&A. I do expect kind of M&A to really kind of kickstart again next year.
Yeah, looking forward to some more deal making. And final takeaway, I always like to ask if there are any tips or interesting suggestions for the audience. Traditionally, I always ask, what are you reading? But actually, people are listening to more than they read to, thankfully, these days. So any recommendations, any podcasts or books that have really caught your interest that you think would be interesting for the LFP audience?
I think I'll shout out to the one that you highlighted actually before in Acquired. I really like storytelling, to be honest. Yeah. I think stories are great. And so any podcast that you can kind of find that tells stories is great. So I would go Acquired. I think you can spend a good few months going through all the content there.
Yeah. Well, that's sort of next level in terms of distribution and in terms of episode length as well. Yeah. We tend to have a sort of a conversation that runs to almost an hour on this show, and some of the Acquired episodes are
6-7 hours.
Yeah.
Yeah.
But it's fascinating, and the insights the guys are surfacing there are unique, I think.
Yeah,
Aman,
absolutely.
Thanks so much for coming on LFP and sharing your insights and the work of the team on the state of fintech in Europe. I think there was a lot in there, and if you're in the investing audience or you're in the founder audience, I think there's some real nuggets from this conversation that should help you on your journey. And I very much appreciate your time. Thank you very much.
Thanks very much for having me, Tony.